Hello, my friends. Today is October 18th, and this is Markets Weekly. So, this past week was a pretty volatile week in markets, but if you zoom out a bit and see that, over the past few months, the equity market could only go up, but now it looks like there's some two-sided risk. Sometimes it goes down. So, maybe a little bit of a change in the mood of the market. Now, this week, we're still in a government shutdown, so we don't have any official data. The betting markets are suggesting that the shutdown could go deep into November. So maybe we won't have data for some time. And concerningly, if no one's working, no one's collecting the data. So even when the government opens, we might not really get any official data. So we're going to be flying blind for some time. Today, let's talk about three things. First off, we have to talk about the regional bank scare that we had the past week, where credit concerns were prompting a pretty big sale of a couple regional banks. Secondly, let's look at some private data to see where the economy might be heading. And lastly, we have to talk about the parabolic ascent of gold and silver. All right, starting with the regional banks. So if you look at this price index of regional bank stocks, you can see that there was kind of a tumble. So what happened was that a couple regional banks got sold significantly because there were reports that they had to write down some of their loans made to an investment fund that lost money. Now, this is occurring during a broader context where there seems to be a little bit more concern in the credit markets about, maybe credit is not as good quality as the pricing suggests. So credit spreads are still pretty tight. Now, in the past few months, we've had the bankruptcies of two pretty large companies. We had Tricolor, which was a company that basically specialized in lending to illegal immigrants, and also First Brands, which was a company that had a lot of business in auto parts. Now, those two companies are both privately held, so they don't have the same public disclosures, but it's easy to see them as idiosyncratic. So when it comes to Tricolor, of course, the president has a different immigration policy. He's enforcing immigration law now. And so, when your clients are getting deported, obviously that's not going to be good for business. When it comes to First Brands, there's some allegations of potential fraud, and there's always fraud in the corporate space, right? So, maybe these two failures could just be idiosyncratic, or maybe they're systemic of something that's a lot deeper. And so with that cloud in mind, the market was very jumpy when it came to reports that these regional banks had lost some money. But over this past week was also a very big week for bank earnings, so we can take a step back and we can kind of look broadly to see whether or not there's a systemic risk, maybe there's a whole bunch of bad loans, or maybe these are just really idiosyncratic events and the market is getting a bit too jumpy. Now, first, let's start with the mega banks. Obviously, if you are a bank, you have tremendous amounts of data. A lot of people have checking accounts with you. You make loans, so you have your finger on the pulse. Now, looking at Bank of America, you can see that they're saying credit quality is really good. It's actually improving, right? So they're a huge, ginormous bank, but again, there's just one bank. What if it's just something in the regional banks? So if we look at the large regional banks, let's say Truist, what are they saying? In their earnings presentation, you can see they're saying the same thing. Credit quality is not just fine, but it's getting better. Loan loss reserves coming down, charge-offs also declining. What about U.S. Bancorp, also a large regional bank, saying the same thing? And actually, basically all the regional banks are saying the same thing, as are the big banks. Credit quality so far in the banking system appears to be improving. Now, one thing to keep in mind is that after the great financial crisis, the structure of the banking system has changed significantly, such that when we do have credit issues, they're really unlikely to come from the banking sector. So in the great financial crises, the banks made a whole bunch of bad loans, and those bad loans caused them to lose a lot of money, which in turn caused a banking crisis that basically morphed into a great financial crisis. The regulators don't want that to happen because consumers, households view bank deposits as safe assets. Even though technically they're not safe, you're lending unsecured to a bank. But when people put money in a bank, they think of it as safe. And so when you have issues in the banking sector, that causes panics. So they put on all these regulations to make sure that banks became much more conservative. So today, a lot of lending actually happens through what they call shadow banks. So For example, before the great financial crises, the commercial banks made a whole bunch of mortgages. Today, most mortgages are actually originated from mortgage lending companies that are not banks, that are just basically private financial companies. And you can say similarly with many other things, right? So let's say that you are a middle market company. If you want to get a loan, you could go to a bank, but increasingly, you could go to a private investor, like a private credit fund, and get a loan there. If you look at this chart of bank loan growth over the past year, you can see that a tremendous amount of loan growth from the commercial banks is not to, say, corporations, but it's to what's called non-bank financial institutions, non-depository financial institutions, basically financial companies that are not banks. And if you look at that chart, you can see there's a big jump. Part of it was because of a reclassification. So in any case, banks like to lend to these private financial companies, and then these private financial companies then lend to the real economy. So a lot of bank lending today is done indirectly. And so when there are credit problems, let's say a company can't pay, it's a problem for the shadow bank, for the private non-bank lender, and then the private non-bank lender will have to deal with it. Now, before it goes up to the bank level, the private lender is going to have to exhaust their resources. And so it's an extra layer of safety for the commercial banks. So the commercial banks, they're lending to, let's say, a Blackstone or a Apollo, basically these fancy, sophisticated financial sponsors. And then the credit funds managed by these guys then go and do the lending. So it's, in my personal view, very unlikely for there to be any credit problems in the regulated banking sector, simply because so much of the risk has basically been moved to the private space. And there you could have some issues. But so far, at least, you see a little bit of that with the public traded business developed corporations, the BDCs, not having a good quarter. But so far, it seems okay. So I guess we'll watch that going forward. Okay, the next thing we want to talk about is the state of the economy. So we don't have any publicly collected data, and probably won't have it until deep into November. And who knows, maybe the government prefers it this way. But we do have some clues from some private data sources as to how the economy is doing. Of course, we want to go first to the mega banks. The mega banks, like I mentioned earlier, have their finger on the pulse of the economy. But let's hear it from JP Morgan, the biggest bank of them all, the one with the most, most data on the real economy. When asked about the state of the consumer on their earnings call, JP Morgan basically said the consumer is fine. Everything is okay. They don't really see any stresses. And, if you look at, say, card spending data from American Express, you'll also get the same picture as well. Card spending is up. Now, to be clear, American Express and maybe JP Morgan probably has a more affluent slice of the consumer market. But we also got the Fed's Beige Book last week. So even as the government shut down, the Fed continues to work. And one of the things they do is they go and they talk to all their contacts in industry and try to get a qualitative sense as to how the businesses are performing. Now, according to the Beige Book, the economy is, it's not great, but it's not bad. It's basically just kind of in stall speed right now. So the Beige Book suggests that, hiring is low, but, there's not like a huge amount of firing. Consumer spending among the affluent, good. Among the less affluent, not as great, but, it's still basically at stall speed. So that's kind of consistent with what's been happening over the past few months. So looks like it hasn't deteriorated so far. But I think the biggest puzzle when it comes to the economy right now is the divergence between the labor data and GDP growth. Now, when you look at the Atlanta Fed, again, Atlanta Fed still works. Their GDP now estimates are really high. According to their GDP estimates, everything is booming. Now, you can look at the stock market and maybe draw some conclusions there. But as we all know, the stock market is not the economy. It's honestly less and less related as time goes on. But at the same time, we also know that hiring is slow. So how can you have strong GDP growth when you're not having more workers, right? In order to produce more goods and services, you have to have more people working. So this is kind of a conundrum that I think is the topic du jour when it comes to the economy and also what the Fed is struggling as well. Uh, if you're an optimist, you could say that maybe there's this huge productivity boost, maybe due to AI, that's causing companies to be much more productive without growing their labor force. Although I would point out that there are a lot of anecdotes that suggest that AI actually isn't really super productivity enhancing for most companies. Probably helps a bit in coding, but then they also say that the engineers have to spend a lot of time to fix the bugs in the AI. So one of these data measurements is wrong. Either GDP is too high or the labor market is not as bad as people think. So this is something we'll find out probably not for some time since there's no official data. And again, maybe the authorities like it that way. Okay, the last thing we want to talk about is the parabolic ascent of gold and silver. Now, if you are a subscriber to my work, you know that I have a market view portfolio. The whole year, basically, we had no equities exposure, but we did have about 50% weight in gold. Now, that sounded very strange earlier in the year, but hopefully a little bit less strange today. Gold has basically gone parabolic, far outperforming the equity market. And of course, its little brother silver has as well. Now, I think this is actually really good because I'm happy that gold is going up, but I think it's also really worrying. When things go up slowly, that's great, slow and steady wins the race. But once you reach this kind of parabolic ascent, it doesn't really correct sideways. The parabolic ascents usually correct violently downwards. And also, you don't really know when the correction ends, when the parabolic ascent stops. Now, if you zoom out and look at silver, for example, you can see throughout the decades, it's just gone straight up. But every time it's gone straight up, it's also gone straight down. And to some extent, gold does this as well. So what are the drivers for this huge rally in gold? Honestly, in a bull market, everyone is a genius. So everyone has their theories as to why the price goes up. And then when they see the price goes up, they think their theory is correct. And then they feel like a genius and they buy more. But at the end of the day, is that really why gold is going up? So again, we talked about last time the debasement trade, very popular. Gold is going up because the dollar is, depreciating, debasing, going to zero. But then again, inflation is at 3%, or a better market signal would be the 10-year Treasury yield, right? Around 4%. If you were having a massive dollar debasement, if you were having a tremendous amount of inflation, you would not expect the 10-year yield to be at 4%, right? So this debasement stuff is obvious nonsense, but people who believe that, they're buying gold, gold prices go up, they feel smart, maybe they buy more. Another popular narrative is that, maybe there's tremendous amounts of geopolitical risk in the world, but so far it looks like Middle East war risk is going lower. And in addition to that, it looks like the president wants to speak with President Putin again. So maybe there's a potential future de-escalation in geopolitical risk as well. So that doesn't seem likely as well. So at the end of the day, this is just momentum, basically what drives a lot of assets today. Price goes up, so you buy more, you lever up, you buy more again. And that's probably why you can have these violent reactions like we saw on Friday, where you had kind of a sudden tumble, especially in silver. Whereas people become levered, they feel greedy, lever up more, and that makes it more volatile and more fragile. Now, one other thing that I'll note is that over the past few years, a lot of people have commented that maybe that gold is not performing as well because a lot of people who would buy gold, people who are afraid of, let's say, the fiscal unsustainability, who want to have quote unquote hard assets, are instead buying crypto. Now, if you look at the price of Bitcoin, it did well for most of this year, but over the past few months, it just really hasn't gone anywhere. And honestly, it looks like it's trending lower. And reports suggest that a lot of people were really levered last week, lost a lot of money. And so if they're souring on Bitcoin, maybe some of those guys will go back to gold, which actually has performed very well so far. But in any case, when you're going parabolic, you don't know how high you can go. But ultimately, I think there's significant risk of a sharp pullback. And I'm not saying that Friday was the case. That actually seemed kind of mild. but that is probably coming going forward. So it's reason to be cautious. But again, not telling you it's bearish because you don't really know how high the parabola can go. All right, so that's all I prepared for today. Thanks so much for tuning in, and I'll talk to you guys next week.